The Bank of England on Thursday raised interest rates by 75 basis points, its largest single hike since 1989, and warned of a prolonged recession as policymakers look to temper market expectations for further aggressive monetary policy tightening. The 75 basis point increase takes the bank rate to 3%, its eighth consecutive hike to the main lending rate after the Monetary Policy Committee voted 7-2 in favor. One member voted for a 0.5 percentage point rise, while one preferred a 0.25 increase. However, the bank appeared to challenge the market's pricing of future rate rises. The majority of the committee judges that, should the economy evolve broadly in line with the latest monetary policy report projections, further increases in bank rate may be required for a sustainable return of inflation to target, albeit to a peak lower than priced into financial markets, the MPC said, offering uncharacteristically specific guidance to the market. The MPC noted that its updated projections for growth and inflation indicate a very challenging outlook for the UK economy as it looks to bring inflation back toward its 2% target. UK GDP is projected to decline by around 0.75% over the second half of 2022, reflecting the squeeze on real incomes from surging energy and tradable goods prices. Conditioned on the elevated path of market interest rates, growth is projected to continue to fall throughout 2023 and the first half of 2024 as high energy prices and tighter financial conditions weigh on spending, the bank said. This would be the longest recession since comparable records began. Unemployment is expected to rise to 6.5% by 2025. As well as a prolonged period of recession and a significantly worse economic performance than that seen in the US and Eurozone, the bank also expects no growth in labor productivity and a fall in business investment. Bank of England Governor Andrew Bailey reiterated in a press conference following the announcement that the central projections conditional on the market-implied path of bank rate serves as a reminder that we should not increase bank rate too far. The MPC judges that the path of the bank rate required to return inflation sustainably to target is shallower than that priced into financial markets, he added. Economists had anticipated a less hawkish tone from the central bank after the change in the UK government. New Prime Minister Rishi Sunak's likely return to a more conventional fiscal policy after the brief and chaotic tenure of predecessor Liz Truss calmed the markets and meant that monetary and fiscal policy was no longer pulling in opposite directions. Inflation spiked to 10.1% in September and is expected to rise to 11% in the fourth quarter, the bank said, though it expects consumer price increases to fall from early next year as the energy price falls out of the annual comparisons. In its central scenario conditioned on market-implied rate paths, inflation falls below target by the second quarter of 2024. Meanwhile, mortgage rates have risen sharply on higher interest rate expectations, placing further strain on households. After its emergency bond buying intervention last month prevented the possible collapse of the UK's pension fund market, in light of plunging government bond prices caused in large part by Truss fiscal policy announcements, the Bank of England revived its plan to start selling gilts, UK sovereign bonds, which commenced on Tuesday. Hugh Gimber, global market strategist at JP Morgan Asset Management, suggested the bank had little choice but to deliver on the market's expectations of a 75 basis point hike on Thursday. Such a large hike may appear unwarranted given signs that UK activity is already contracting, but there is scant evidence as yet that the slowdown is sufficient to tame inflation, Gimber said. All eyes will now turn to Finance Minister Jeremy Hunt's fiscal statement on November 17, where the government will need to strike a fine balance between supporting the economy and a credible medium-term plan for debt consolidation. We are seeing so many countries raising interest rates to curb inflation, and there is no evidence of it bringing down inflation. We would like to know your opinions regarding the recent interest hikes going on all over the world by so many countries in the comment section. Also like the video, subscribe and turn on notifications. Thanks for watching.